Right now, something is happening in the financial system that could completely upend your savings, and almost nobody is talking about it. This isn't your typical credit crisis where bad loans are the problem. No. This is a liquidity crisis. And it's far more dangerous because it can take down even supposedly healthy banks overnight. If you think your money is safe in your savings account, you need to watch this. So, what's the difference? A credit crisis happens when banks lend money to people who can't pay it back. But a liquidity crisis is about cash flow. Banks look perfectly solvent on paper, with plenty of assets. The problem is they can't turn those assets into cash fast enough to meet withdrawals. Sound familiar? It should. This is the exact same failure point we saw in the Great Depression in 1933, the savings and loan crisis in the 80s, and the global financial crisis in 2008. History is rhyming, and the warning bells are ringing loud and clear. To understand why this is so critical, we need to look at the very foundation of our banking system, fractional reserve banking. It's a simple concept. You deposit your money, and the bank keeps a small fraction of it in reserve, lending out the rest. This works fine as long as everyone doesn't ask for their money back at the same time. Your deposits are the bank's short-term liabilities, but they use that money to fund long-term assets like mortgages and business loans. When confidence breaks and withdrawals start to accelerate, it creates a death spiral. The bank has to sell those long-term assets to get cash, but they can't be sold quickly without taking massive losses. This is how a healthy bank can collapse in a matter of days. We saw it happen with Silicon Valley Bank and First Republic. Their balance sheets looked fine. Until, suddenly, they weren't. What's pouring gasoline on this fire? The aggressive interest rate hikes we've seen since 2021. The Federal Reserve, in its fight against inflation, has rapidly increased rates. This has absolutely crushed the market value of the long-duration assets that banks hold. Like government bonds and mortgage-backed securities. Think of it this way. If a bank bought a bond paying 2% interest, and now new bonds are paying 5%, nobody wants to buy that old 2% bond unless it's sold at a steep discount. This has created hundreds of billions of dollars in unrealized losses across the entire banking system. These are paper losses, hidden away on balance sheets, but they become very real and very fatal. The moment a bank is forced to sell those assets to meet deposit withdrawals, the problem is getting worse because liquidity is being drained from the entire system, and the risk is becoming highly concentrated in regional and mid-sized banks. There are a few key forces at play here. First, we have quantitative tightening. The Fed is shrinking its balance sheet, which effectively pulls money out of the financial system. Second, the Treasury is issuing a record amount of debt to fund government spending, which also sucks up available cash. Third, the Fed's reverse repo facility, which was a place for money market funds to park cash, is seeing its balances fall, meaning that cash is now looking for a home elsewhere, not necessarily in bank deposits. And finally, we have a ticking time bomb in commercial real estate. A massive wall of debt is coming due, and with high interest rates and falling property values, many borrowers won't be able to refinance. This will put immense pressure on the regional banks that hold a large chunk of this debt. They are the most exposed and the most vulnerable part of the system right now. When you look at the big picture, it's clear we're heading toward a major dislocation. This kind of crisis creates what we call asymmetric risk. For the average person who remains overexposed to the traditional banking system, the risks are huge. You could face withdrawal limits, where you can't get your own money out, or even bail-ins, where a portion of your deposits could be converted into bank stock to save the institution. The downside is catastrophic. However, this crisis also creates asymmetric opportunity. Those who understand what's happening can take steps to protect themselves and even thrive. It's not about panicking, it's about preparing. By reducing your counterparty risk, meaning your exposure to a single bank failing, and by holding real liquidity yourself, you can insulate your wealth. So what does this mean for you? It means you need to reevaluate where you're holding your wealth. Is it all sitting in one bank account, earning next to nothing and exposed to these systemic risks? This is a time to be proactive, not reactive. Reducing your exposure to vulnerable banks is step one. This might mean diversifying your assets, not just across different stocks or bonds, but across different types of institutions and even different forms of money. Consider holding a portion of your savings in assets that are outside the banking system, things that don't carry that counterparty risk. Furthermore, crises are when assets get mispriced. During the turmoil, fundamentally good, high-quality assets can be sold off in a panic, allowing savvy investors to buy them at a deep discount. Think of it like this: when everyone is running for the exits, they often throw the good out with the bad. Those who have prepared, who have liquidity on hand, are the ones who can step in and purchase generational wealth at bargain prices. This isn't about timing the market perfectly. It's about being prepared for the volatility that is almost certainly coming. The goal is not just to survive the storm, but to emerge from it stronger than before. The next few months and years will be a crucial test for our financial system. The decisions you make now could determine your financial future for decades to come. Don't be the one caught by surprise. Pay attention, do your own research, and take action to protect yourself. Thanks for watching. I know this is a heavy topic, but it's incredibly important. If you found this information valuable, please hit that like button and subscribe to the channel for more updates on how to navigate these turbulent financial times. Stay safe and stay informed.